Hi, I'm Lawrence Parker Brown. Welcome to the Inside Network. Welcome to this In-Depth. We'll be exploring the hottest topic for advice groups here in Australia, and that's the private credit market. To join me and to offer all of his experience and knowledge is Managing Partner at Barwon Investment Partners, Head of Real Estate Credit, Jonathon Pullin. So Jonathon, it is such a hot topic. It's a topic for clients to think about, for the advice community, but also regulators. Could you lean into what the recent ASIC 820 report findings were and how they're relevant to this conversation?
Sure, and thanks for having me today, Lawrence. In respect to the recent ASIC 820 report, really what that is exploration into private markets here in Australia, and more specifically, private credit. What the report does is observe practices in the sector and provides guidance for better practices moving forward. If I was to summarise the findings of the report, really they centre around improving transparency for investors. That transparency starts really with fund managers describing their funds and the investments that their funds are making, through to allowing investors to understand the underlying risk composition of the portfolios to which they're investing in. That presents itself in loan-to-value ratios, how valuations are struck within these portfolios, and importantly, also what ASIC are looking for is better transparency around managers and the fees to which they're taking from these investments. All of that really goes to drive a better assessment of the overall investment by investors. And on balance, it's a great thing for this sector. Real estate credit is a sector that continues to find a permanent place in investors' portfolios. And with that, we want better practices across the whole of sector for longevity of this investment practice.
So Jonathon, this is a key asset allocation for a lot of advice groups. For those that are potentially entering it, what are some of the things that they need to be thinking about if they're new to this space?
Sure. Well, I think if I reflect on what we see as the main issue for a lot of advisors who are coming into this space for the first time, or they might have some limited experience, often what we see and we hear back from those advisors is they struggle to get a good grasp on the underlying risks of the portfolio or the fund to which they're investing in. Gone are the days where your allocation into real estate credit was just into one bucket and it was one size that fits all. With the increased size of this part of the market, we now have the benefit of investors and advisors being able to allocate across a broad risk spectrum into this opportunity set. You know, at one end of that risk spectrum is obviously the lower risk, lower returning private credit investments, and at the other end is the higher risk, higher returning side of those investments. What we've noticed is that when advisors come in to understand where they sit on that risk spectrum, that can be a challenge. Hence the reason for the ASIC 820 report, providing guidance for advisors to understand where they sit on that spectrum. It's a thing, it's a component really that we encourage advisors to demand answers to these sensible questions that they ask of their manager, again, to understand where they sit on that spectrum.
Now, Jonathon, if we're looking across that spectrum, what does the conservative approach look like in terms of a process? And as an advice group that's considering it, what are they missing out on? Is there a reduction in yield that comes with this approach?
Sure. So in terms of creating a conservative portfolio, how we've gone about doing that is really reflecting on our experience. Through our experience in investing in this sector, what we've found over time is that construction lending on occasion can be challenging, particularly in periods where there's high inflation. So what we look to do is avoid material construction loan exposure in our portfolio, and then we focus on the other areas. So the other areas outside of the construction stage is obviously the front end stage where sites are being bought, land is being bought, and also the back end stage. So where the development is complete, it might be an apartment project, a townhouse project, but that product is fully built out and we provide loans whilst the developer sells down that stock into market. And finally, another area where we find conservative, good risk-adjusted returns is around existing property. So this is property where there's no form of development being undertaken. It might be an existing office building or hotel trading up to stabilisation. Often there are bridging loans within that journey that can be taken that provide good risk-adjusted returns. So that's the construction of a portfolio where we've landed, where we're able to, over the longer term, through cycles, generate good risk-adjusted returns for our investors.
So Jonathon, the conservative approach avoids different parts of the market. When you put that together, is there a change in the yield composition that the end client would receive?
Yes, there is. Obviously, we're not investing in these higher risk construction loans. So the trade-off in that is the yield. So we've got a lower returning investment in these residual stock loans and existing asset bridging loans. However, on a risk-adjusted return basis, we believe they present a very compelling opportunity against the higher returning investments in construction.
Excellent. If I think about the budget, it's quite a substantive change in some of the societal expectations moving forward. How does it affect the property market and hence real estate credit?
It is a major budget. There's a lot of stimulus there or inferred stimulus in there around residential property development and lack of supply in the market, and they're obviously wanting to improve that going forward, which are all good things for our country. In terms of how that plays through to non-bank real estate lending and our fund in particular, the dynamic going forward really favours residential property developers. There is stimulus there that remains in place, which will drive demand from investors into completed residential product. That, moving forward, will likely lead to increased opportunity flow for us as a real estate credit lender, as there's an improved viability into developers' feasibilities and projects moving forward. So we welcome a lot of these changes going forward.
Blending the terrain we're in now, the impact of the budget, what's your market outlook, Jonathon, as we are sort of halfway through 2026? And particularly for an advice group that's trying to think, how do we try and build resilient yield for our clients? What are some of the key messages you'd share?
Well, we remain positive, both in respect to the long-term outlook for real estate credit and the short term. Why is that? Well, in the short term, we've obviously got a period of heightened volatility. We've got the goings on in Iran. We've got inflationary pressures coming through the system. Debt investments, and further to that, real estate credit investments with the enhanced security of real property behind each of the loans, provides a good investment in periods like we are in now. Volatility is high. A debt investment obviously benefits from good buffers behind it in the equity buffer that it sits preferred to, and provides steady returns through periods like we have now. Over the longer term, we are sitting in a sector here in Australia which continues to steadily grow. The dominance of the major banks is still there, but we've seen that steadily pull back year after year, creating good opportunity for non-bank lenders like ourselves.
Well, it's a space that we'll continue to monitor. It's a space that so many advice groups are actively investing in. It's a pleasure to have your insights, and I hope we'll have many more down the track. Thank you, Jonathon.
Thank you.